Picture this. It's 1864. Abraham Lincoln is president. The Civil War is still raging, and a group of Pennsylvania businessmen decide it's a good time to start a bank. That bank is still around today, with $50 billion in assets, a brand new deal with Penn State University covering 90,000 students, and its first dividend increase since 2007. I'm Hudson Thomas.
And I'm Lana Chen. Today we're talking about FNB Corporation, ticker FNB, a Pittsburgh-based regional bank that just reported first quarter 2026 earnings on April 16th.
The headline numbers were technically slight misses against estimates, but dig one layer deeper and the story gets a lot more interesting. Pre-provision net revenue grew 17% year over year. The efficiency ratio dropped to 56.1%, down 240 basis points in a single year. That is real operating leverage. Lana, what's your quick read?
My quick read is that FNB is doing the quiet work that doesn't make headlines but does move share prices over time, consistently improving efficiency, improving credit quality, and now a structural deposit partnership that could define the next decade. Let's break it down.
FNB Corporation has been around since 1864. That's 162 years of Pennsylvania banking. Headquartered in Pittsburgh, they've grown to over $50 billion in total assets, with more than 350 branches across 9 states: Pennsylvania, Ohio, Maryland, West Virginia, North Carolina, South Carolina, Virginia, Georgia, and Alabama.
The business runs in 3 segments. Community banking is the bread and butter: loans, deposits, mortgages, treasury management. Wealth management handles higher net worth clients with investment advisory and trust services, and insurance rounds it out with commercial and personal lines. Community banking drives the vast majority of revenue, but wealth and insurance add diversification that most banks their size don't have.
And here's the why now that caught my attention. July 2026, FNB launches a full-scale banking partnership with Penn State University. We're talking 90,000 plus students, faculty, and staff. That's not a marketing campaign. That's a structural deposit acquisition at scale, building relationships with customers before they've established banking habits anywhere else.
From a competitive standpoint, what makes FNB interesting is their combination of community bank relationship culture with a genuinely modern digital platform. Their eStore digital branch and the 360 View AI platform drove online loan applications up 300% year over year. That's not a legacy bank pretending to be digital. That's actual behavioral change from customers.
And they've doubled in size over the past decade under CEO Vincent DeLee without a single transformative acquisition. All organic. That kind of discipline is rare. Let's talk about the man running the show. Vincent J. DeLee Jr. has been CEO of FNB Corporation since 2012, 13 years at the helm of a bank he's helped grow from roughly $10 billion in assets to over $50 billion today. He's a Pittsburgh native who joined FNB in 2004 and worked his way up through commercial banking and strategy.
What I find notable about DeLee is his consistency. He's set efficiency targets and hit them. He said FNB will grow organically and done exactly that. He has explicitly said the bank is not interested in transformative M&A, and he's kept that promise when plenty of peers have stumbled chasing deals. His Q1 commentary was unusually upbeat, describing the bank as positioned to continue gaining market share without needing rate tailwinds.
Analysts who follow him closely characterize him as a disciplined operator who's more interested in building lasting franchise value than short-term optics. Given that the efficiency ratio just hit a multi-year best, and the bank just raised its dividend for the first time since 2007, the results seem to be backing up the rhetoric.
All right, let's get into the financials. FNB Corporation is a mid-size regional bank with a market cap of about $6.4 billion. At a current price of $17.94, it's trading at roughly 11 times trailing earnings and just under 1 times book value, a price-to-book of 0.95. That discount to book is actually one of the more interesting facts about this company, and we'll come back to it when we talk peers.
Dividend yield is 2.7%, with that new 8% dividend hike to 13 cents per share. Not a huge yield, but the hike is the signal, management saying they're confident in the earnings trajectory.
On the income side, Q1 2026 net interest income was $359.3 million, up nearly 11% year over year. Non-interest income added another $91 million. Together, that's $450.3 million in operating revenue for the quarter, which was slightly below the $456 million estimate. A modest miss, but not alarming.
And the EPS, 38 cents diluted. Right at analyst estimates by some measures, a penny short by others, depending on which consensus figure you use. But again, one layer deeper. Pre-provision net revenue was $192.4 million, up 17% year over year. That's the internal profitability engine before credit losses.
The net interest margin came in at 3.25% for the quarter, which is down 3 basis points quarter over quarter. But March's exit rate was 3.30, meaning the quarter actually got better as it went on. That's meaningful for Q2 guidance.
Efficiency ratio, 56.1%. That's down from over 58% a year ago. For a bank this size, getting below 56 would put them in genuinely elite company among regional peers.
On the balance sheet, $50.6 billion in total assets, average loans of $34.9 billion, up 2.5% year over year, and average deposits of $38.4 billion, up 3.8%. Common Equity Tier 1 capital ratio at 11.4%, up 70 basis points from a year ago. That's a well-capitalized bank building cushion.
Return on tangible common equity came in at 13.2%. Tangible book value per share of $12.06, up 11.4% year over year. Credit quality looks clean. Non-performing loans at just 34 basis points of total loans and net charge-offs at only 18 basis points annualized.
Cash generation for fiscal 2025, operating cash flow of $482 million, free cash flow of $376 million, and the buyback program, $35 million repurchased in Q1 alone against a $300 million total authorization. Overall, FNB's financial health is solid, the operating leverage is real, credit is clean, and the capital position is strengthening, though the NIM headwind from potential rate cuts is worth watching.
Let's see what Wall Street makes of all this. The consensus is buy, with about 6 analysts covering the name. 5 have buy or outperform ratings, 1 has a neutral. Average price target is around $19.40, which implies about 8% upside from here.
Piper Sandler is the bull at the table with a $21 target, highest on the street. They maintained their overweight rating, citing the Penn State partnership as a structural deposit story that the market hasn't fully priced in. Truist reiterated their buy with a target around $19.50, pointing specifically to the efficiency ratio trajectory. KBW kept their outperform, calling out credit quality at 18 basis points of net charge-offs as a differentiator.
The one neutral is from Compass Point at $16.50, which is actually below the current price. Their concern centers on NIM sensitivity in a rate-cutting environment and the stock's valuation relative to larger regionals with more fee income diversification.
On the Q1 earnings call itself, management's tone was notably optimistic, citing PPNR growth, the NIM exit rate of 3.30, and capital strength as pillars for confidence in the full-year guidance. The guidance itself, NII of $1.5 billion for the year, implies sequential improvement from Q1's annualized run rate.
Okay, let's do the bull case. I'll go first. The Penn State partnership is the headline, but operating leverage is the real story. A 17% increase in pre-provision net revenue isn't a one-quarter fluke. It reflects 2 years of efficiency investments paying off simultaneously, and the efficiency ratio improvement from over 60% to 56.1 puts FNB ahead of many larger regional competitors. Layer on, credit quality at 18 basis points of net charge-offs is genuinely excellent. The balance sheet is fortified with CET1 at 11.4%, and trading at a discount to book value means there's a revaluation story if the return on equity keeps improving. If NIM holds above 3.25 and the Penn State deposits start coming in by Q3, This is a bank that re-rates higher.
And here's the bear case. Both EPS and revenue came in slightly short of estimates in Q1. For a bank trading below book value, you need consistent beats to drive re-rating, and FNB just didn't deliver that. NIM declined 3 basis points quarter over quarter even before any potential Fed rate cuts. If the Fed cuts twice in 2026, FNB's NIM guidance gets tested. The geographic concentration is also a legitimate concern. 9 states sounds diverse, but the majority of loans are in Pennsylvania and adjacent markets. And the Penn State partnership is genuinely exciting, but converting 90,000 students to active depositors takes years, not quarters. The market may be pricing in success before execution is proven.
How does FNB stack up against its regional banking peers? Let's use price to book as the benchmark, since that's the language of bank valuation.
FNB at 0.95 times book is actually trading at a discount to book value. Compare that to Huntington Bancshares, ticker HBAN, at about 1.0 times book, Citizens Financial, CFG, at 0.85 times, and Fifth Third Bancorp, FITB, at 1.45 times. So FNB is in the middle of the range, closer to book value than the premium names.
What's interesting is the efficiency ratio comparison. FNB at 56.1% is actually more efficient than Fifth Third's 56.5% and better than Citizens at over 60%. So the operational execution is there. The market just hasn't awarded FNB the premium valuation yet. That gap between execution and valuation is the fundamental bull thesis.
Fifth Third's higher multiple reflects its stronger fee income mix and larger brand. But if FNB keeps closing the efficiency gap and delivers on the Penn State deposit story, the valuation discount could narrow meaningfully over the next year or two.
Quick look at the options market. Options volume in FNB is relatively light. It's not the kind of name that generates a lot of speculative options interest, given the low beta of 0.90.
Post-earnings implied volatility has settled below the 25th percentile, and the put-call ratio near 0.82 reflects a mild bullish lean from options traders. No unusual open interest clusters or large directional bets that we can identify. For investors who trade options, the muted IV environment means covered calls could be a reasonable way to generate income while holding the position.
On the insider front, there haven't been any notable open market purchases or sales filed in recent months by FNB executives or directors. No significant insider transactions to report.
The absence of insider selling ahead of a quarter featuring record PPNR and the first dividend hike since 2007 is at least a mild constructive signal. Management clearly wasn't looking to reduce exposure heading into what turned out to be a strong operating quarter, even if the headline numbers came in slightly below estimates.
The main risks to track on FNB. First, Federal Reserve rate cuts. FNB's NIM guidance could get pressured if the Fed cuts rates more aggressively than the market expects in 2026. Every 25 basis point cut has implications for the interest income side of the ledger.
Second, commercial real estate credit quality. Pennsylvania and Ohio markets have pockets of stress, particularly in office and retail. FNB's loan book is well managed with 18 basis points of net charge-offs today, but that can shift quickly in a downturn. Watch provision expense. Management guided $65 to $80 million for the full year.
Third, deposit competition. The Penn State partnership is a smart play, but FNB is competing for college-age depositors against national banks, fintechs, and neobanks with enormous marketing budgets.
And fourth, execution on the digital transformation. The 360 View AI platform and eStore are showing results, but technology transformations at community banks have a mixed track record. The 300% growth in online applications is impressive, but integration risk remains.
Okay, bottom line on FNB Corporation. This is a 162-year-old Pennsylvania bank that has quietly doubled in size over the past decade, is generating 17% pre-provision revenue growth, just raised its dividend for the first time since 2007, and is about to onboard 90,000 Penn State students as banking customers.
The headline numbers slightly missed Q1 estimates, and the stock trades at a modest discount to book, suggesting the market needs more proof of execution. The key metric to watch is net interest margin trajectory. If NEM holds above 3.25% and the March exit rate of 3.30 suggests it can, and if the Penn State partnership delivers even a portion of its deposit potential, FNB has a compelling path to a higher valuation.
It's not a flashy story, but then again, banks that double in size organically over a decade rarely are. We'll leave you with a quote that feels right for a bank built on relationships and education. Benjamin Franklin, an investment in knowledge pays the best interest. With FNB about to bet its next chapter on 90,000 university students, it seems the bank has taken Franklin's words literally.
That's a nice one. Knowledge compounding, just like a well-managed loan book.
That's going to do it for today's episode of Charged Alpha, your guide to the S&P 500, one stock at a time. We covered FNB Corporation, ticker FNB, 162 years of Pennsylvania banking, and they're just now raising the dividend. The story is still writing itself. And hey, if you want to run the same research workflow we used to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, crypto, bonds, REITs, commodities, no sign up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street